one of the biggest hurdles that I had to overcome was my own greed. It's something as simple as that, is realizing the greed and overconfidence were costing. So that was certainly a pivotal moment.
We're delighted to have Charlie Burton join us here today. Charlie's got 28 years experience in the financial markets, in the Forex, and also he's a money manager as well. So he's got a vast amount of experience he's going to share with us.
I came from a martial arts background, and getting kicked on the ground was something I was used to. You need to be able to get back up. And the problem for a lot of people in trading is they don't, because we're human beings, we're emotional creatures. But if you can desensitize the emotional range, then it puts you in a better position. I shorted the S&P back in February. We came into 2025 with a huge amount of euphoria and expectation. So at the highs, I want to be seeing really frothy, euphoric sentiment, and at the lows, I want to see pessimism, obviously.
You know, it's about letting your winners run and cutting them losers short, but understanding that it's okay to take a loss, because if you can't take a loss and you're chasing a win on every single trade that you take, you know, you're never going to be able to be successful at trading in the financial markets. But in terms of dollar, where do you see dollar going from here?
Down,
yeah. Hello and welcome to Two Blokes Trading Podcast. We're delighted to have Charlie Burton join us here today. Charlie's got 28 years experience in the financial markets, in the Forex, and also he's a money manager as well. So he's got a vast amount of experience he's going to share with us today. We're delighted to have him on board. Welcome, Charlie.
Thanks ever so much for having me on. And so it's always a pleasure to come on and speak about and chat about, you know, the financial markets, isn't it?
For sure. I mean, 28 years is a long time, Charlie.
You can see the wrinkles. You can see. That's just from the screen. From the screens. Yeah.
Where did it all start?
It started in the late 90s, and so I was in fund management anyway. So I worked for. I was in insurance first of all, so Scottish Provident, and then went into fund management, Old Mutual Fund Managers, but not as a fund manager. I was an advisor to independent financial advisors. So I used to advise financial advisors on our funds and all of that sort of stuff. And so the funny thing was, one of my financial advisors I should deal with said to me one day, he said, would you be interested? He said, I'm going to go on like a 4-day options trading course. He said, do you want to come with me? I've got like a +1 ticket. And of course, in the late 90s, we were all buying and selling penny shares in the late 90s, because I was just buying stuff on the side, just from tips from colleagues and stuff who were in the city and all of that. And I thought, that sounds interesting. And so I went on a 4-day stock options trading course, and that gave me an opener into the financial markets as an independent trader. So prior to that, it was just buying some shares just in the UK here via whatever broker at the time, and so that was got my foot in the door, and then had to learn myself, because there was no social media then to learn. I remember paying someone £250 just to show me how to place a trade. So, I'd learned the broad concepts of options trading, but what's a limit order? What's various different orders that were there? So, very different world back then.
For sure. And obviously then that transmitted to you getting into the Forex world, and that's where you kind of apply your trade now?
Well, but my initial few years were all stock trading. So I was buying US stocks, doing the fundamental research, and then basically buying shares and then writing cover calls against them. Yeah. I didn't really get into FX until the turn of the century. I don't know when exactly. Probably I went full-time trading in late 2001. So I guess it was sometime around there that I started to trade FX as well, and obviously stock indices as well. So even to this day, 80 to 90% of my trading is FX, but I still trade some commodities here and stock indices, of course.
Sure. And I suppose, is there particular pairs that you go towards? And again, like, why FX as opposed to any other market? And is it just something that you're drawn to? Is it something that you find yourself more consistent within the markets, or why particularly FX?
I I think it's habit. I'm a creature of habit. So during right up until about 2010, if you'd have interviewed me back then, I'd have said 70 to 80% of my trading is S&P futures.
Yeah.
And so although I was trading FX then, it was still a larger share was S&P trading. So I've always been a believer in focus. So for example, coming back to some of your questions there, euro dollar contract is my favorite FX pair. It's the world's largest currency pair. It's the most liquid, blah, blah, blah. So that still, of the FX trading I do, still gets the lion's share of the trading. So I've always been that sort of trader. I don't like having a watch list of 40 or 50, whether it's FX pairs or stocks or indices. I like trading a few markets more of the time. So it wasn't a strategic decision, and it still isn't to this day. It's more just a force of habit that I've done it for so long that's where I'm at. So, in 5 years' time or 10 years' time, who's to say that it couldn't be something else that is getting the lion's share? But as of today, that's the case. Yeah.
Sure, especially with digital currencies potentially coming in as well, and taking over. And was there a pivotal moment for you when it all changed? Or did you just, because of your experience within stocks and other areas, you went into FX and some other asset classes, but was there a point where you just said, okay, now I've really got that trading edge?
Well, I think most experienced traders will have a series of points like that through their trading, because our trading all evolves. So my early years were predominantly stocks and stock indices, and started trading ETFs and the likes. And then, of course, a pivotal moment would have been when I went full-time trading. So I didn't mean to go full-time as such. It was just I'd got to a point in my career where I was exhausted from all the work, all the corporate entertaining, all that stuff, which all sounds very good, but when you do it year after year, it gets a bit tedious. So I thought, actually, I've been trading on the side for a few years now. Let's see if I can make that transition. So that certainly was pivotal. But prior to that, one of the biggest hurdles that I had to overcome was my own greed. And so overconfidence. So have a little bit of a winning spell, then get overconfident, bit of over trading, probably trading a bit oversized as well, certainly in that first couple of years or so. Then seeing the equity curve come back down, and then having to start again in the cycle again, tighten things up, become a bit more disciplined, and all of a sudden the equity curve would start going up again. And I would go through that cycle several times over a period of a year until I realized, actually, if I can just rein in that greed a little bit, that overconfidence that emerges on the back of a winning spell, then maybe I won't give it all back and having to start again, So that was certainly a pivotal moment, is something as simple as that, is realizing the greed and overconfidence were costing me.
Sure, absolutely.
So that certainly was in the early years. And then, of course, as the years go on, so the early 2000s, I was doing a lot more intraday trading. So, of course, you're going to learn from that, and you have to have more discipline for that. And all the way through to another pivotal moment in my trading would have been when I first started to apply adding into trades, which wasn't probably until 2013. So only 12 years ago from where we're recording this, but that was another pivotal moment. Obviously the great financial crisis. So there's lots that have defined me as a trader, and I suspect there will be more going forwards. But I've pretty much made every mistake in the book anyone has who's been trading for more than a few years. And so the point is learning from those mistakes. So can you overcome that? So for me, I came from a martial arts background, and getting kicked on the ground was something I was used to. And so
getting back up again,
you need to be able to get back up. And the problem for a lot of people in trading is they don't know how to get back up. They shy away from losses, losing trades, all of that. That creates hesitation, all those sorts of things, which I never really struggled with, because the rejection that you get in the markets, and I still get rejected to this day, all of the time in the markets, but I just got a thick skin. And so overall now, that thick skin is probably what defines me as a trader. Being able to just deal with the rejection.
100%. Every day is a learning day when you're in the markets. And like for people who are interested in moving into full-time trading and kind of on the edge, tilting towards wanting to do it, but obviously then it comes risks, because once you're trading then full-time, then you've got to manage your expenses, your bills, everything changes in terms of you have to be able to have that consistency to be able to make sure your bills are paid, to make sure you still have your lifestyle that you want to have, and so on. And do you think that had a major difference when you changed over to full-time trading in terms of psychology of how you traded? Because was there more at stake when you were trading? It's just for listeners that maybe want to take that jump towards full-time trading. How would you, or I know you gave a lot of advice already, but what's the best way to deal with that?
Well, firstly, I would say have 2 years of salary sat in your bank account, so you don't have to take an income from your trading. Take the pressure off. Everything you can do to take the pressure off, the better. When I did it, I was still in my late 20s at that stage. I didn't have commitments, didn't have children, all that sort of stuff. Would I do it today? Probably not. With everything I know, putting myself under that sort of pressure, if I had a young family, then I probably wouldn't do it. But if someone wants to do it, I would always say have a couple of years worth of income sat in the bank, which is what I did. So I didn't have to draw any money out. I could just focus on, I didn't know it at the time, but I was just focusing on the process of just trading and not having to worry about, did I make money at the end of that month or not? But I would also say, in order to take the pressure off, have another source of income. If you give up all of maybe your partner works, and that to me would be a great balancing tool. Is to, if you've got a partner, your partner works, you've agreed together that yes, you're going to be you're going to be full-time trading, but at least there's an income coming in which pays the bills and whatnot. Again, everything to take the pressure off, because anything that puts pressure on is going to change your style of trading without you even realizing it. When I first went to becoming a professional money manager as well, a regulated money manager here in the UK, there were subtle little things. Even though I'd been trading 20 years at that time, there's still little things that you start to think about and second guess, and as to, should I put this trade on for the fund, or put this trade on my own account, but I won't put it on the fund? And you become a bit more conservative. And it's amazing the little things that you will do. So coming back to full-time trading, don't underestimate how good you are now as a part-time trader. You won't be as good when you go full-time. So you've got to offset that by taking the pressure off in as many areas as you can. The main one is being income.
Sure. I mean, psychology plays such a big part in trading and financial markets, in life in general. We don't realize in the back of our head, we've got this, we've got something there that tells us to make different decisions at different times. And the thing that I always tell our students is, like, just think objectively, stick to your trading plan. For me, if you have a strategy and you have a trading plan, you just stick to it, and if you start to veer from that plan or that strategy, it's going to go wrong, unfortunately. And tell me, like, in terms of your own trading style as well, I know we had a little kind of discussion before the podcast itself about, your sentiment and so on, but are you more technical, fundamental sentiment? Do you mix the three together? How do you kind of go about building a bias in the markets?
Predominantly technical. And so what comes with technical is the sentiment to an extent as well. So predominantly technical and sentiment. But of course, I think you have to have an awareness of the fundamentals that are going on. And there's no better time to, as right now, with regards to fundamentals of what's going on in the world with tariffs and everything else. So to give you an example, I shorted the S&P back in February. And now we can all... I've got that on record and stuff. I have a live trading group myself and stuff, and I was on a
You can give that a plug if you
podcast back
want.
then. But it's not about, oh yes, I shorted up, several weeks ago. The point was there were technical divergences. So I do like divergence patterns at times if it comes in with other factors. So we came into 2025 with a huge amount of euphoria and expectation in the market. So coming back to sentiment, all of the surveys were expecting, better stock performance on the back of the last 2 years as well. So euphoria amongst both market analysts, the Bank of America fund manager, global fund manager surveys, everything was all predicting stock markets to go up. Obviously, retail were. And so when sentiment is, as I say, really frothy like that, I'm going to pay more attention to something like a technical divergence, because technical divergences get blown out all of the time. But if they come in line with other stuff, then they can be quite useful. So we had a big down day. I wasn't shorting it prior to that. We had a big down day. I can't remember what the news was now, in sort of mid to late Feb. And it was on the back of that. We had the technical backdrop, we had a sentiment backdrop. And so to me, I didn't know what was about to come with the whole tariff wars, starting to really build at that stage. But you have the fundamentals, as I often say, are lagging, and they play catch up with what happens technically first of all. So that's an example of taking a technical pattern in conjunction with the sentiment. So at the highs, I want to be seeing really frothy, euphoric sentiment, and at the lows, I want to see pessimism, obviously.
Sure. Okay. Brilliant. Well, look, I'm kind of the similar trader as well. I mean, like, certainly for me, I suppose from my side, I'll always take into account the fundamentals. I build my sentiment through a number of different sources, including our AI as well. But then I kind of bring that sentiment to the charts. And all I'm looking for is confirmations from the charts. You know, that kind of way. Once I've got my confirmation from my charts, I can then, I'm happy to execute at that point. And tell me, do you trade around, is there certain hours in the day that you trade, or are you trading around news events or, opening hours?
Because I'm a positional trader nowadays, I'm not an intraday trader anymore. I stopped intraday trading years ago. And so I'm only a swing positional trader. Having said that, I'm here in my office most of the time. So yes, I will be watching major news events, and very often I'll be putting on swing trades on the back of those events. So because if something materially changes, we've got non-farm payrolls coming up in the week that we're recording this. Now, that could be a really interesting one, because at the moment, what with Doge and job losses and everything else coming, and that's a really important narrative story. So I think that will be an interesting one to see what those jobs numbers come out. They're always interesting, but it could be even more interesting over the months ahead. So yeah, I'll very often be looking to put a positional trade on the back of news. So I can be trading at placing trades at any time of the day, based on whether it's a fundamental news event and after that, or if not, then quite often I'm just waiting for price action to do something to confirm something that's a technical break or whatever it might be. So yeah, but even though I'm a swing trader, a positional trader, I'm always keeping an eye on the markets throughout the day.
Sure, absolutely. And do you have like a strict risk management policy or rules? I mean, and I'm going to ask you this in a slightly different way later on, but for your own trading, like, do you have like a certain percent that you have that cutoff point, or are you more kind of malleable depending on the markets?
As far as percentage is concerned, then yes, I have a set percentage. It depends on what accounts I'm trading. I trade 6 different accounts. So if I'm trading one of the fund accounts, then I've got different funds with different aggressive levels. So one of them is only 0.5% risk of the total value under management per trade, and I always use a stop loss. And yeah, I've got an aggressive one which I can be trading at 1% per trade, 1% of the capital at risk. So it does depend on the account and the aggressiveness that I'm trading at. A lot of the time, I'll dip my toe in the water anyway. So I'll go in with a smaller position first of all, and then start to build it if the market starts moving in my direction. So, but yeah, I'm always using a stop loss. I don't do anything else other than using a stop. And very often I will get stopped. And if the market, if nothing major has changed, then I'll just get back in. So, especially on things like divergences, because quite often when you're coming off of a low point, a market will probe back down, and it might be enough to still get me stopped, but I'll just go back in. So I'd rather do that than not use a stop loss.
I suppose, and in terms as well of not trading your own account, but trading a money management account, how does that affect you? Is there any psychological difference between trading your own money as opposed to trading somebody else's money?
Well, I guess it depends on your ethics, because I've met money managers who say, "Oh, I'd never trade my own money," and I find that really strange. Yeah.
Right. Yeah.
I find I think it's the responsibility that you are managing someone else's money, and so for me, I've always got in my mind, I want my investors to sleep well at night. So whatever my actions are, I want them to be able to sleep well at night. So yes, I see it as a responsibility. Does it affect me? I think in the first year or so of trading, it was an adjustment. To say it affected me is probably the wrong description, but certainly it was an adjustment because I had to change hats and think about and consider an investor who's just seeing trades coming in. They know nothing about the trades, and so it's yes, it's an adjustment in that way.
There's no padding on the walls, which is a good sign anyway.
No, that's in the next room. Yeah.
And how do you manage expectations then? And you kind of touched on it upon there, but in terms of, getting new clients on board or current clients, how do you manage expectations? And obviously you've got different risk categories in terms of, where people want to kind of, if they want to be more risk adverse or whatever the case may be. But how do you, first of all, do you have kind of a percentage that you're looking to gain a week, a month, or obviously you have your own kind of, you don't have that at all, though?
Because I'm positional trading, a lot of the trades that I'm in can be multi-month moves. So there's no, oh yes, I'm aiming to make you X percent a week or even a month, because I don't like to make promises to people and say, oh yes, this is what I'm. There's an overall, there's an overall annualized number that my investors will know that I'm targeting, but to break it even down into a month on month, I can't even do, because I'm holding positions sometimes for months at a time. So I try to under promise the majority of the time as far as performance is concerned. What I try to spend more of the time when an investor comes on, and I'll do a periodic update for the investors, is I'm more just talking about my processes, what I'm actually doing, rather than talking about the returns, because if you focus them on the returns, that's the only thing they're going to think about. Whereas if they understand what you're doing overall, what your objective is, then I always say the returns will take care of themselves.
Yeah, 100%. And I suppose looking at the current outlook of the markets, obviously, we're getting bombshells at the moment with these announcements of tariffs. I mean, how are you finding the current market conditions?
Amusing. We knew this from when Trump was in the first time, so we knew this was coming. And I think overall, I think it's a great time to be trading. Yes, things can turn on a dime, but it's still nice to be in an environment where there's more volatility rather than there's not. So I think there's one thing with traders. Traders have to learn to embrace uncertainty. And we're in a great that word, if you Googled it right now, I'm sure would be coming up quite a lot. But as traders, it's a bit like when we traded through COVID. A lot of people, it really affected COVID psychologically, whereas I was quite happy because nothing had changed overall.
Moving in one way, really, right?
Yeah. I mean, so yeah, and so I think you have to get used to embracing uncertainty as a trader. And so the uncertainty is, oh, what are the tariffs going to be, or what's going to happen in the Middle East or Ukraine, Russia, all of this stuff going into the mix is, it's a huge amount. Trying to dissect it is tough. But that's why I say you just got to come back to your trading plan. And that's what I do. Just come back to my trading plan. What am I trying to achieve within that plan? There's always going to be curveballs being thrown in. Just when you're in a position it looks like it's running all right, then all of a sudden there's a movement going in the other direction. But I have this overall approach to trading that, of course, if you're in a trend, there's going to be counter trends and moves, and it depends on whether you're trying to be in and out a bit more or you're trying to hold on for the bigger move. So within a trend, if you're following the news and what's going on, every time there's a pullback, of course there's going to be a load of news which is accompanying that pullback, which a lot of traders are going to become susceptible to and think, oh God, that's it must be a complete reversal now. Well, you just take any historical chart and look at any trend, well, where there's a pullbacks, I'm sure at every one of those pullbacks there was news which looked like it was going to reverse. You have to just try and decompartmentalize a bit away from the noise.
100%. And in terms of the dollar outlook with all these tariffs coming in, I'm interested just to have your opinion in terms of what do you think is the kind of future outlook for dollar with everything that's going on. Obviously, it's going to have a major impact across all of the economies, not just the US economy, right? But in terms of the impact, like for me, obviously, there's been like the kind of correlations that were there before are kind of not so much there before. And like you said, you have to decompartmentalize it. You have to like think differently. You have to generally you're looking at certain correlations and you're going, okay, but that's not so much there anymore. So it's thinking differently, looking at the markets with a different aspect. But in terms of dollar, where do you see dollar going from here?
Down,
yeah.
Look, there's plenty of arguments, and I could sit here and give you all of the arguments as to why the dollar's going to go up. Of course, on the back of tariffs, again uncertainty, the inflation story potentially there in the US as well. So there are all the reasons why, and I think in the short term, this week that we're recording this, probably the dollar, I'm certainly expecting at least, or allowing for the dollar to strengthen this week. But I think there's another story that I'm looking at over the medium term. I'm talking over the next 6 months plus. And that is, for the first time in a long time, we're going to be seeing, I believe, a loss of trust in the US administration from its trading partners. So they're still going to be trading with the US, but it's just a little bit of a loss of trust. And Paul Tudor Jones was talking about this very thing just in February, where he was talking about there was something like $2.7 trillion in treasuries are held by foreign economies, and something like $23 trillion across treasuries and stocks and property overall. And if you lose that trust a little bit with your trading partners, some of those trading partners may end up saying, maybe we don't want to hold quite so much in US assets as we've previously held. So that's part of the story a narrative that I'm seeing further down the line. I think that I'm really pleased, although there's still a lot of uncertainty as far as the EU is concerned, really pleased with the big wake-up call that Germany's had. And it's about time that that Germany did wake up. It's like a super tanker just been drifting in this recessionary mode for the last few years. And I just think that super tanker's starting to turn. It's an amazing economy if they can do this. And with this huge amount of funding coming, it feels like the beast is being woken up a little bit. You've got a German chancellor who's saying, actually, we're not going to completely bow down to the US. We need to be a bit more independent. And I think we're going to see that trickle across the EU. So, and with the euro dollar being the biggest contract, I'm looking over the medium term as I am seeing the scope for the euro to appreciate. In the very short term, who knows? But that's the playbook that I'm looking at, is euro back up at 115 to 120. So quite a punchy outlook, really, but sometimes you have to.
Like, you have to have that bias, and you have to have conviction in your bias as well. Otherwise, you're never going to be successful in trading the financial markets. It's not to say that bias won't change at any given point, because
Absolutely.
things can change.
Yeah.
And you have to be malleable in the markets. You can't be kind of like stubborn, and that's the one thing that hurts traders the most, is when they're stubborn and they allow, they think it's going to turn, and they allow them losing trades to go against them. And in terms of like trading mistakes, just on that point, I mean, what tips would you give to traders then, kind of maybe new to intermediate traders, to kind of build that consistency, to be able to get to that point where they're not getting that kind of roller coaster ride, and they're just having more of a consistent approach to the markets?
Yeah, one thing I think it was a good point you just mentioned just before we move on to that was, when it comes to, I believe you do need to be a stubborn trader, but you do also need to have that point where you accept that your analysis is wrong, or your game plan, your trade plan is wrong,
Sure.
and be willing to switch allegiances, just like a guerrilla in warfare. You need to be able to switch and I'm exactly the same, like I've just said about the euro. But if the euro gets back down sub 105, it's, I'll be reassessing the downside here. But coming back to traders, I think one of the biggest things that my biggest beef with traders out there, both new and intermediate, is they are holy grail chasers. And I'm sure you see this. Everyone does. I was a holy grail chaser in my formative years. Mm-hmm. And there's nothing wrong with that, because you've got to try and find an edge in the market. But I just wish that traders would spend a little bit more time looking at their emotional range, because a lot of the decisions that traders are making, they might actually have a reasonable approach to the market, but they'll still not make any money with that approach, because they react too much emotionally to what's going on. So if a trader can reduce the emotional range, you can't have no emotions. I think Mark Douglas said that famously in his book, Trade Without Emotion, but it's impossible, really. So, because we're human beings, we're emotional creatures. But if you can desensitize the emotional range, then it puts you in a better position when the market does reject you, and you just go and have a series, a few stop outs, in a row or whatever it might be, because statistically that's going to happen. But you just shrug that aside and you just take the next trade, and you take the next trade, then you've got it. But most traders don't. They react either from getting despondent, angry, all of those sorts of emotions, and then they're like, they walk away from the market for a week or two, and then they've just gone and missed a great period. And likewise, on the opposite side of the spectrum as well, when they've had several winners in a row, then like me in my early couple of years, getting a bit overconfident. So if we can restrict that emotional range, then we'll be better off, because we don't emotionally react to what's just happened. Because what has just happened is just the last trade that in the next 1,000 trades we're going to take. So who cares? But we need to try. It's easy for me to say that. Applying that is another thing. But if people could spend more time looking at that, I think they would be better, and they would execute better. They wouldn't, do all those other mistakes.
Yeah, well, look, absolutely agreed. And I think there's a number of reasons for that. And I think sometimes it's the attachment to the amount of money that you're trading with. It's like, don't trade with money that you're not willing to risk, because that money is at risk. And, don't get to a point where you're trading with money that actually you need to pay a bill with or something, that kind of way. And that's a big problem. Second of all is, when traders come to emotions, for me personally, like I said to you at near the start of this podcast, it's like, think objectively. Yes, you have to be kind of robotic. Yes, you're going to get losing trades. And what people don't realize is, look, trading is about losing. You have to, to gain money, you have to lose money. And it's a part of the process. And unless you can accept that, out maybe, 4 or 5 trades, depending, losing trades out of 10 is going to happen. And it's just about, it's about letting your winners run and cutting them losers short, but understanding that it's okay to take a loss, because if you can't take a loss and you're chasing a win on every single trade that you take, you're never going to be able to be successful at trading the financial markets. And it's a real strange thing to tweak in people's head. Is like, look, you have to lose to win. You have to accept to lose a trade. because and learn from that trade. Why did it go wrong? Sometimes there's nothing that can be learned from a trade because it's just the markets have just been, you might have seen a knee-jerk reaction in the market, whatever the case may be, but just think objectively, which is absolutely key for me.
Well, I think it was interesting on that. I was speaking to a trader psychologist not that long ago, and he said every time he speaks to a trader, he said one of the first things he asks them is, out of 10, how many winners would you expect to have, out of 10? And the average answer is 8 to 9. And you think, they're setting themselves up. Yeah. But even someone who can logically accept that they might be right, let's say 5 out of 10, 50% of the time, they can logically accept that, like in a conversation. When it actually comes through into trading, they can't accept it. And yet, so I think that it's win rate, and I understand it's programmed into us in life, passing exams, you've got to be right as much as possible and all that stuff. But if we can spend more time talking to traders about overall profitability rather than win rate, then it takes them away from that getting caught up in winning trades, losing trades, rather than saying, well, yeah, but my risk reward ratio on average is whatever, 3R, and looking and managing yourself in a better way. Yeah.
Awesome. Well, look, before we close up the podcast, I'm going to give you some quick fire questions. This is the first for me now, so let's see how you can answer these. Okay, so firstly, what's your favorite FX pair to trade and why?
Euro dollar, but again, just purely because it's force of habit, but it is because it's the largest currency pair. I've been trading a particular piece of technical analysis on it since 2015, so the last 10 years, and those patterns are still in play. So hence why I'm still trading it.
What's the biggest myth in Forex trading?
Oh God, biggest myth. Well, it's got to be the Lamborghinis, isn't it? It's got to be the, become a Forex trader and you can have 10 Lambos. So yeah, probably that.
What's one thing that traders over obsess with, but don't need to?
They over obsess with win rate, as we've just said. That's the bane of my life. People wanting to be right as much as possible. Whereas if they can think about being profitable and not worrying about being right, they'll be far better off. Actually, there was a quick example of this just a year ago. Hedge fund manager in New York had made over 100% in a year with a 24% win rate. There you go.
Yeah. What's one boring habit that actually gives you an edge?
A boring habit. Oh God. The boring habit for me is that I don't trade loads of markets. So I'm quite content. My edge is my focus and just focusing on just a few things. And so I'm not interested in trading every market. There might be a great trend in whatever, minor currency pair or an exotic or whatever. I'm just not interested. So that's probably my edge.
Know the markets you're trading in. And lastly, if the markets were closed for a year, what would you do instead?
Oh, cut grass. I'd be like Forrest Gump on the tractor, just going up and down, cutting grass. I find it very therapeutic. So there you go.
Awesome. Look, it's been an absolute pleasure having you on today. It really has. It's been enlightening as well. And thank you so much for coming on. And hopefully we get you back in the future as well, Charlie. Okay.
No, much appreciated. Thanks for having me on.
Thank you so much.